Hello, and welcome to BusinessVille. Your go-to channel for everything business-related. In today's video, we'll be discussing the reason behind the fallout of Silicon Valley Bank. The collapse of Silicon Valley Bank has sent shockwaves through the tech industry, and many are wondering how it all came to this. What caused the bank's failure? Was it due to mismanagement or external factors beyond their control? Stick around, and we'll go through the sequence of events that led to Silicon Valley Bank's failure. Federal Reserve raises rates. The Federal Reserve is responsible for setting interest rates in the United States, and last year, it raised interest rates from record low levels to fight inflation. This had a significant impact on the tech industry, and in turn, on Silicon Valley Bank, whose primary clients are technology startups. When the Federal Reserve raises interest rates, it makes money more expensive to borrow, which makes investors less willing to take risks. Since tech startups often rely on venture capital, this meant that investors became more risk-averse, making it more difficult for startups to secure funding. Silicon Valley Bank clients face cash crunch, as higher interest rates caused the market for initial public offerings to shut down for many startups and made private fundraising more costly. Some Silicon Valley Bank clients started pulling money out to meet their liquidity needs. This culminated in Silicon Valley Bank looking for ways to meet its customers' withdrawals this week. The bank had a difficult time coming up with the necessary cash, and they were forced to sell off their bond portfolio at a significant loss. To fund the redemptions, Silicon Valley Bank sold on 8th March a $21 billion bond portfolio consisting mostly of US Treasuries. The portfolio yielded an average of 1.79%, far below the current 10-year Treasury yield of around 3.9%. This forced SVB to recognize a $1.8 billion loss, which it needed to fill through a capital raise. SVB announces stock sale. Silicon Valley Bank announced on 9th March that it would sell $2.25 billion in common equity and preferred convertible stock to fill its funding hole. However, the announcement had the opposite effect of what was intended, and its shares ended trading on the day down 60%. Investors were worried that the deposit withdrawals may push it to raise even more capital. Some SVB clients pulled their money from the bank on the advice of venture capital firms, such as Peter Thiel's Future Fund, Reuters reported. This spooked investors, such as General Atlantic, that SVB had lined up for the stock sale, and the capital-raising effort collapsed late. This was a significant blow to Silicon Valley Bank, and they scrambled to find alternative funding. SVB goes into receivership. Silicon Valley Bank's problems continued, and on 10th March, they were placed under receivership by the Federal Deposit Insurance Corporation, FDIC. This meant that the bank was shut down, and the FDIC would seek to sell its assets. Future dividend payments may be made to uninsured depositors. The events surrounding SVB's bond portfolio sale, stock sale collapse, and subsequent receivership highlight the risks associated with investing in the banking and tech sectors. It also underscores the importance of prudent risk management, particularly when investing in high-risk areas. Lessons learned from Silicon Valley Bank's fallout. The fallout of Silicon Valley Bank provides a valuable lesson to the financial industry, particularly to the startup ecosystem. The first lesson is the importance of diversification. Startups and investors need to understand that concentrating their funding sources in a single financial institution may expose them to unnecessary risks. Having a diversified pool of investors, funding sources, and banking partners can mitigate such risks. Financial institutions, particularly those catering to high-risk clients such as startups, need to have adequate risk management measures in place. These measures can help them anticipate risks, identify potential areas of concern, and take proactive steps to address them. In the case of Silicon Valley Bank, it appears that their risk management practices were inadequate, which led to their downfall. Finally, the fallout of Silicon Valley Bank highlights the need for regulatory oversight. Regulators play a critical role in ensuring the stability of the financial system, particularly during times of crisis. The swift intervention of the FDIC prevented further damage to the economy and mitigated the impact of Silicon Valley Bank's failure. And that's the sequence of events that led to Silicon Valley Bank's failure. While the bank had been performing well up until the Federal Reserve raised interest rates, they were ultimately unable to weather the storm. The collapse of Silicon Valley Bank serves as a cautionary tale for investors and businesses alike. It highlights the importance of being prepared for external factors beyond your control and having a solid plan in place to deal with unexpected situations. As we wrap up this video, we'd like to hear from you. What are your thoughts on Silicon Valley Bank's collapse? Do you think they could have done anything differently to prevent it? Let us know in the comments below.